Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of February 10th. Thank you for joining us. If you enjoy the content and you find these videos useful, don't forget to like and subscribe and check out some of our other great content here on our page. But in the meantime, my goal with these videos in this series is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. Looking back to last week, we're going to start the discussion with the job market. So it was a big week for jobs data. Early in the week, we saw that job openings had fallen in December by a pretty significant amount. Around the middle of the week, we saw the ADP employment report showing that private sector jobs increased by 183,000 in January. And at the end of the week, we got the major national report that showed that overall in the month of January, jobs had increased by about 143,000, and the unemployment rate had fallen from 4.1 to 4.0%. Some other important details in the job market last week. We saw that average hourly earnings grew from 3.9% to 4.1% from December to January. Although this is positive because it means workers are earning more per hour, it also could be a warning sign because higher hourly earnings could contribute to higher inflation and inflationary pressures. We also saw that the December and November job reports were revised up by about 100,000 jobs. And we saw that the job revision that made headlines in August with an 800,000 job reduction was actually, with further details and further data, was only a 600,000 job reduction. Still a correction, but a much smaller magnitude correction. The other topic making headlines last week was, of course, tariffs and trade wars. President Trump implemented 25% tariffs on Canada and Mexico and an additional 10% tariff on China. These are our three largest trading partners globally, and almost immediately, the Mexican and Canadian tariffs were paused for 30 days, while the Chinese tariffs remained in place. And of course, as expected, in response, the Chinese government also instituted counter tariffs, specifically on American energy, American agriculture, and American automotive products. Following these tariffs and counter tariffs with the Chinese government, economists noted that the Chinese counter tariff policy seems to be much more targeted than they were initially in 2018 and 2019. Specifically, Chinese tariffs are now targeting conservative and politically impactful districts and industries in those districts, as well as attempting to minimize the impact that the Chinese tariffs may have on the Chinese economy. Last but not least, we saw official trade deficit data for the month of December. And as most economists expected, we saw the trade deficit expand to almost $100 billion. We saw an increase in imports and a decrease in exports, most likely due to the ongoing conversation and threats of tariffs that occurred in December. But given the actual practice and exercise of tariffs in January, this trade deficit metric, especially on a country-by-country basis, will probably be something of concerted attention and concerted concern over the near future. To wrap up the economic side for last week, we saw consumer sentiment out of the University of Michigan, the preliminary report for the month of February. Unfortunately, consumer sentiment fell to the lowest point since July of 2024. We also saw consumer sentiment decreasing across all political affiliations, all age groups, and all wealth groups. In addition, we saw consumer sentiment about their personal finances falling to the lowest level since October of 2023, and we saw inflation expectations for the next 12 months increase from 3.3 to 4.3%, which is the highest level we've seen since November of 2023. These increased concerns among consumers sparked an increased concern in the stock market, and Friday ended up being a sell-off that erased most of the gains that occurred throughout the week. Switching over to the stock market took a big dive on Monday, mostly in response to the new tariffs implemented by the Trump administration on Canada, Mexico, and China. Although, as quickly as the tariffs arrived, the Canadian and Mexican tariffs were paused for 30 days, and the market proceeded throughout the rest of the week, at least until Thursday, to claw back those losses and even post some gains. Unfortunately, the downtrodden consumer sentiment report released on Friday essentially pushed the market back into decline, with all three major indices ending up down for the week. Switching our attention over to the fourth quarter earnings reports from last week, many companies reported better than expected earnings for the last quarter of 2024, although several companies posted softer or weaker guidance for the next quarter ahead than expected. Companies such as Amazon, Ford Motor Company, and the pharmaceutical giant Merck all posted soft quarter one guidance, which ultimately contributed to a fall in share prices for all three. Google parent company Alphabet also reported a slight miss on revenue expectations for the last quarter, and in response saw a nearly 8% decline in share price in one day. Also catching our attention throughout last week was the market for gold. Gold, again, is considered a safe haven and typically a target in times of volatility and uncertainty. And last week, we saw the price of gold gain at a much faster rate than expected. The ongoing Trump tariff saga, as well as the potential for trade wars and additional geopolitical conflict that unfolded throughout the week, added a big boost to the price of gold. Many analysts and economists are now considering how quickly it'll take the market for gold to reach the $3,000 price threshold. Originally, this was anticipated potentially by the end of 2025, but recent estimates have increased this time frame, and some analysts actually see the price of gold reaching the level of $3,000 in the next 60 to 90 days. As we continue to try to interpret the moves in the economy as well as economic policy, gold, as a safe haven for this uncertainty, will continue to be an important point to watch. Shifting our attention to this week, we of course start off with more fourth quarter earnings reports. Approximately 75 of the S&P 500 companies will be reporting their performance this week. Some big name companies, including McDonald's, Coca-Cola, Cisco Systems, and Airbnb will be reporting this week, as well as some major real estate and utility companies. Also this week, we'll see a significant amount of inflation data being published, the Consumer Price Index, the Producer Price Index, and the Import-Export Price Index. Given the mixed results that we saw in December, there's a lot of interest and intrigue as to what these early January results will indicate. Increased inflationary pressures coming from these results could have an impact on future interest rate decisions, as well as future consumer and business expectations for the potential resurgence of inflation down the road. A lot of the attention this week on inflation will be on the Consumer Price Index month-over-month increase. The December increase was the largest we had seen in approximately 9 months, and it was especially driven and exacerbated by high growing food costs and growing energy costs, including fuel. On a positive note, we saw the long-term inflation drivers, specifically shelter costs, increase by the smallest amount they had since January of 2022. These mixed signals make the January reports that we'll receive this week incredibly important in helping to understand the current path of inflation as well as the future trend. Looking ahead even further into the future, as has been the case for the last few weeks, we will most likely continue to watch inflation and the trade picture with tariffs and trade wars, as these two will most likely be some of the most impactful factors of the U.S. economy in 2025. As we wrap up the fourth quarter earnings season, the next big question is, what will be the primary theme for equity markets in 2025? Will it be a return to conversations about the tech sector, growth in the AI divisions, and investment in data centers and AI capabilities? Will the conversation shift to talk about the historically high valuations in the S&P 500 currently? Or will the attention be pulled to the high level of market concentration, with the Mag 7 maintaining a massive portion of overall earnings, growth, and market valuation? Or will maybe the attention shift to the high concentration in U.S. equities relative to the rest of the world? As questions in investment, fixed income securities and 10-year Treasury yields, and ongoing economic policy and trade tensions unfold, we will do our best to capture the most important and the most impactful information and bring it to you here on our weekly market update. As we read through the reports and sift through the data that's released every week, we'll do our best to bring you what's important in an easy-to-understand format so you can stay up to speed on the markets. With that said, thank you for joining us this week. Good luck. Keep your eyes on the economy and the financial markets. And don't forget to come join us again next week for our weekly market update.